Bombs are falling on Tehran, oil on a path to 90, and the Strait of Hormuz, the most important choke point in the global energy trade, has gone quiet. Tankers aren't moving, shipping giants are rerouting around Africa, and a 15% global tariff is already squeezing margins before a single missile was launched. The Fed seems paralyzed, caught between an oil shock that screams inflation and a labor market that whispers recession. Neil Azous is in the house, CIO of Rareview Capital, a man who's navigated just about every macro storm from Goldman Sachs to the front lines of portfolio construction. Together, Neil and I are going to cut through the fog of war and the fog of markets to answer three questions. What's working, what isn't, and what's next? Welcome to The Money Runner. I'm David Nelson. Neil, welcome back to the show. Thanks so much for being with us today.
Yeah, my pleasure, David. Great to be here with you. I wish we were here under different circumstances, but we'll get it together today.
Yeah, and I know my subscribers, and I know fans of the show, and everybody out there watching is very glad that you're on, because you seem to have a real sense of crisis moments like this, and we'll see how bad this is going to be. But I'm going to cut right to the chase. What everybody seems to be talking about is the Strait of Hormuz. Seems like an economic weapon of mass destruction. About 20% of the world's crude travels through this very narrow body of water. And Iran has pretty much said that they're going to light up anybody that tries to go through there. How bad is it? How important is this for us to recover?
Okay, sure. So first of all, if you would like to have a conversation right after this about the specter of war and a framework and how to think about these things or these events, I'm happy to go through that with you. It's something that we've spent a lot of time on and studied over the years, and we apply a process to it to keep the emotions, low. Specifically regarding the Straits of Hormuz, it's not just a conversation anymore about crude oil. It also includes LNG or liquid natural gas, which is very important as well in today's world. And you're right, it is a significant choke point potential in the world for those natural resources. But it's important to keep it in context. And here's what I mean by that. If you had rewound the tape 35 years ago in the United States, before the advent of shale exploration, or the United States becoming the largest exporter of crude or producer of crude in the world at 12 to 14 million barrels a day, that would be a major source of concern for the United States. But today, as a net exporter of both crude oil and LNG, we're able to weather that storm much better than other regions, especially the emerging markets. Now, again, just going down that same lines, if you think about it in the context of Europe, that's a real heart attack. Let me explain. If your energy bill was $300 5 years ago, and it turned into $700 or $800 a month due to the Russia-Ukraine war, and now over the last 2 days, you've watched European natural gas prices double, up 100% in 2 days. And your bill goes from $800 a month to $1,500 or $1,600 from $300 several years ago. That's a heart attack in that region. It distinguishes the United States versus Europe in energy independence, what that means to its net import-export profile, their currency, the euro exchange rate versus the US dollar. The implications are much more significant to other regions that rely on that. And that's to their detriment, not the United States. So
let's talk about the tape then, because the tape seems to reflect what you're saying.
Yeah.
We had a pretty decent recovery on Monday. We actually crawled into the green ever so slightly. And then I wake up in the morning, Europe was just toast. Emerging markets were toast.
Right.
Today, everything was down. Europe was down, certainly far more than we were. And we seem to we recovered some of what we had.
I have a very basic answer to that, and I don't believe what I'm going to say is unique if you operate in a global macro or multi-asset world and follow this stuff pretty regularly. Let's use the United Kingdom as an example, and their their various bond markets. Theoretically, or on a piece of paper, they considered an emerging market that's masked by inflows into their real estate over the years. So they run what's called a twin deficit. Inside that twin deficit profile makes them look and feel like an emerging market. So over the last 2 days, the UK gilt market, or their equivalent of our US Treasury market, has exploded higher in yields by 30 basis points versus us going up 5 or so. And so the acute point is being felt the most in the countries that are running twin deficits, the UK being the poster child for it first in the European bloc. Secondarily, countries that are also dependent on importing, you will see their equity prices move faster than the United States down as a result of that new economic profile, but also because of some crowded positioning, which I'm sure we'll talk about in a few minutes. But in general, that's a much bigger issue than the U.S. being a net exporter of that. We just don't have the same profile that we have when you had that entire Iran revolution or the oil crises in the 1970s. That's just not who the United States is anymore. So we feel pretty insulated from that. And finally, I would just highlight or dovetail something from that that's super observable to me. Well, I certainly respect the advent or evolution of new asset classes like digital currencies or what gold and silver have done over the last year. It's a reminder that when the United States Commander-in-Chief comes in today and says there's no more issues in the Straits of Hormuz, we've destroyed Iran's navy, we are in control of it, and crude oil drops immediately as response to that. It's a reminder that what is the backbone of the US dollar? If you read any textbook on the history of the US dollar and what props it up and what makes it, quote unquote, David, the reserve currency, the answer has always been the United States is surrounded by 2 oceans and is protected by the most advanced and largest armada in the world. There's zero question to the world today and yesterday or in the Straits of Hormuz that the United States Navy is the largest and most advanced in the world. And they're putting that on display, which is another way of saying they're putting the US dollar reserve status on display. And that's the point, that when you see these other markets, either their bond markets sell off due to inflation concerns, due to the energy prices rising, or their stock markets falling at a faster rate, and our currency bid up and our equity markets being more resilient and the rates markets being more contained, it's a reminder of King Dollar.
That's an important point. I want to talk about that because it seems that these things kind of happen. It takes a long time for investors to notice a titanic shift in the marketplace, and certainly the move into international securities, the move into the metals that has been building for the last couple of years has probably gotten somewhat crowded. And the last people in. So many of the people I suspect that are selling international securities today just got there. They're not protecting gains; they're protecting losses, or try to stem the losses. And even some people late to the gold trade. Or am I seeing that? Am I seeing that wrong?
No. You're absolutely seeing that clearly. And I'll give you something tangible to actually think about how to see that clearly. If you're familiar in the trading term on an institutional algorithm, they call it the VWAP, which stands for volume weighted average price. It's a typical way, for those who are not familiar with the term, where a fund manager may give an order to a broker dealer and they buy it over the day based on the volume. You're able to actually go and see what the volume weighted average price is in, say, Bitcoin over the last 3 years. And that VWAP price is around $87,000 per Bitcoin. Okay. At 63,000 or wherever it is today, that by definition means that every investor on average who showed up to Bitcoin in the last 3 years is now underwater, purely by definition. Okay, not everybody, but that's the price. You could make the same argument of what you just described. If you bought gold over the last X months or whatever, silver, and you came in the 8th or the 9th inning, you're underwater. Right? It's the same exercise. So the question always becomes is, what's your stop loss or the choke point that says I'm underwater by too much. I can't take this anymore, and I'm going to get out
That's
of
a
it.
great point. I had, I I've been in this business a while. I hadn't thought of doing that. Looking at the VWAP over, say, not a day, but
Oh.
a multi-year time frame to get a sense of where everybody is. That's great. I like
I
that a
mean,
lot.
David, think about that. If I told you that the VWAP, say, example on Bitcoin is 87,000 and it's at 60 or 63, where I come from, you're down 25%. Typically, you get terminated for that type of performance. But the people who believe in that, they're okay being down 25% on average. Okay, maybe it'll come back. Maybe it won't. Maybe it'll take 5 years. Maybe it'll take 5 days. I don't know. But that's your starting point now.
That's really great, Neil. I'm going to shift gears for a second because you touched on the bond market, and obviously a very important asset class for most investors out there. But the script didn't really play out for a lot of people that they like they thought it would. Typically in these geopolitical events, very often treasuries are a safe haven, and they certainly weren't that this time. It's got to be about oil. Let's walk me through that.
Yeah, that's a fair observation. I'm going to talk about something a little bit technical for a second, so we can get our bearings right, and then we'll address what you just described, which I think is very astute. That observation. So number one is, as a reminder, pre-Saturday, using the 10-year U.S. Treasury yield as our barometer for this conversation, the interest rate had dropped from, say, 4.25% down to 3.93%. In that process, the call option skew, so the bet that in the options market that the yield would go lower, the interest rate would fall, was at a 3-year high. It was very jacked or elevated. And so it allows for a rubber band effect to come in if two things happen. One is an inflationary exogenous shock, such as what we're seeing in crude oil or natural gas, for example, or two, what they call more of a terms of trade shock to the world. So if you're a net importer globally of these commodities, that's just, again, a shock to your terms of trade of what we just described in Europe. That's an example. It's an inflationary example. And the natural response, without overthinking it, would be is we can't cut an interest rate. We might actually have to raise an interest rate, right? The interest rate skew from that central bank, wherever it is, shifts 180 degrees. It takes a little bit more than this. But I'll give you the reaction here is if we were expecting an interest rate cut, a probabilistic outcome of, call it 75% by July for a quarter point cut, that cut now has been pushed out to September as a result of this terms of trade shock or this inflationary shock due to the impact of oil. Remind yourselves that sometimes people discount oil. There are 3 speed governors in the world in this order: the US dollar, crude oil, and the US interest rate. Crude's number 2. How much does it cost to go from A to B in your car in the emerging markets? How much is it going to cost to get to my office today? That matters a lot in other places besides New York City. And so that's the speed governor of the world. It's real. It can change interest rate probabilistic outcomes or the path of that policy very quickly. We're seeing it slowly over here, but it's certainly repricing in other nations very quickly.
It has to show up somewhere energy touches just about every line item of the income statement in one way or another. So even here in the United States, there's going to come a point. Well, let me ask you flat out. At what point, for oil and natural gas, at what point is this not a transitory event and it starts to be a more systemic problem? We really start talking about bringing numbers down.
So there's always a rule of thumb. They use this word, whether it's a Federal Reserve white paper or a bank PhD in their economics department. Rules of thumbs or yardsticks are for every quote unquote sustained 10% move higher in the barrel, that could equate to a 0.5% higher move in CPI or inflation, something along those lines, give or take. So for me, when I hear the word sustained, I think in the short-term trading markets, people would think 30 days. In Fed terms, that's 6 months. So if we went from $70 a barrel to 100 for 30 days, yeah, we'll have a short-term noise, and everybody would put a footnote or a qualifier when data comes out and say that's transitory. If it was 6 months, that's a different discussion. That gets baked into models in the medium term. And so I would look for something in the 1 to 6 month range for that to happen. And I would just also at the same time, while I'm mindful of that risk, I would also remind everybody there are a lot of levers to pull if you are the administration. You can release the Strategic Petroleum Reserve. You can export at a faster rate, things of that nature. You can ask OPEC to increase their production versus what they increased a couple of days ago, which was a miniature amount. And so there are a lot of levers to pull before that occurs. So my gut tells me it's short term. It'll be labeled transient, but a lot of things have to go wrong. Now, this goes back to the whole point of you saying that in the specter of war, how important is the Straits of Hormuz? It's important, but there's also other waterways, the Panama Canal for Latin America and Venezuela, what's going on with Russian crude oil through the Baltic Seas and North Sea and Norway, right? If one of those have a problem, or there's a refinery that goes off online while the Straits of Hormuz is blocked, that becomes a different discussion, meaning you can deal with one blockade, not multiple issues.
You know, we were talking about bonds, and I left something out. I mean, I don't think we have a conversation about bonds without at least mentioning, you know, some of the credit stress that we've seen in the financial sector. I don't profess to be an expert in the sector, but I can look at a stock and see that it's down 10, 15%. There's something going on here. How real is it? Is there real damage that we should be talking about here?
Yeah. So I'm going to give you a take because earlier in this interview, David, you highlighted the resiliency of Mag 7 on the stock side of things, but we're all watching certain stresses in the credit markets unfold simultaneously or prior to the Middle Eastern war or regional conflict. Let me address the stock side first. There is a concept that says it's very simple. Go to Facebook, Meta. Is Meta allowed in China? No. Is Amazon allowed in China? No. Is Microsoft allowed in China? Not unless it's pirated, right? So those companies legitimately receive zero revenue from that region, and they get zero revenue from Iran either. If anything, right, I'll use Apple as an example. 100 million people become accessible to buy an iPhone. That sounds like a new revenue stream for Apple, actually, right? Freedom brings iPhones and communications and text messaging and apps and new trade and commerce, right? So what happens in these times of stress, those companies act actually like a ballast in a portfolio because they're in islands of their own regarding where they get their revenues, where they're banned from, and they become a safety zone to put money into, especially, hey, let me get out of the stock that's 5 times more volatile and go buy the company that mints the most cash flow, like Apple, right, or Microsoft. So I find them to be defensive in these times of stress in the world. To be fair, they've also been cranked heavily year to date, as you know. And so buying something that's weak like that, the damage has been done. Outflows have already occurred. So you already have a cushion there to see some reversals as speculation comes out of somewhere else.
Can we dig into that trade a little
Sure.
deeper, a little more granular? Because I find it interesting. We've been trashing, at least I have. I've been trashing the Mag 7 for the last number of months, and there's some things out there that have been bothering investors. The lack of cash flow because of in the case of Amazon, literally taking their free cash flow down to almost zero because of the investments that they're making. Not so bad really at Microsoft or Alphabet. Meta, it shows up there as well. And yet we're going back to this trade. You and I had talked in the past about what could upend the current narrative within the technology sector would be that if one of the Mag 7 came out and said, you know what, we're going to pull back on our CapEx a little bit, that would cause a reversal of a lot of popular trades, a couple of them in particular. The hardware sector that builds out these data centers, a lot of the doodad makers, the electronic component makers, even within industrials, a lot of the companies that are out there building these data centers, that would upend because the capital moved from one side to the other. The tape looks today like an announcement like that was made, but I can't find it anywhere.
No, you're right. In our last interview, I think in mid-December, or in our other conversations, my sort of strong view would be you need to hear Mark Zuckerberg from Meta or Jensen Huang from NVIDIA get up on their stage during their earnings call and say, we're done spending money, or we're lowering it, right? We just heard the opposite of it the entire earnings season over the last month. And so now there's a bifurcation on what I said, what these managers are saying in terms of how they're spending money, and now how the market is perceiving them going from asset light businesses to asset heavy businesses, right? And spending on their CapEx. The truth is, my bedrock view is always the P&L is the voting machine that never lies. So my view, humbly, is incorrect for the moment. And if you believed in what I said, something else occurred that impacted these equities, and it's been a meaningful impact. Big picture wise, I still believe they're going to spend money, and they're going to spend big money, and we're not hearing anything different from that if they want to stay at the forefront of the competition. And so ultimately, over a 1-year horizon, the money will be spent and it'll continue to grow. And I still think we're in the second or third inning of that. To suggest that we're in the ninth inning is different at this. And there's no evidence of that.
Look, reversion to the mean is a bitch, and some of these trades got pretty extended, and maybe that's all that we're seeing here.
Yeah.
Let me go back a second. Because we've been talking about this, obviously very important, conflict that's taking place, and it is a regime change. I mean, the regime that was there is gone, so by definition, there has to be a regime change. There's nobody left. This could be a good thing, but could also leave a vacuum. We don't know how that's going to work out. We always talk about the bad things that could happen here, but I don't want to fall into the group think. Maybe we should ask ourselves the question: what could go right? And I think it's worth noting that not every outcome here is negative. Khomeini, he was personally responsible for blocking every diplomatic off ramp for the last 36 years. He vetoed nuclear deals, refused to negotiate on missiles. So his removal, in some ways, if this works out, that risk premium that's been in the market, since October 7th, 2023, that could go down some. No.
Right. All right. Okay. I appreciate everything you just said. I'll kind of give you my thought process on this and take it with a grain of salt, because during the fog of war, when people think they know what they're talking about, you could just divide that by 2 and start from there. Right. Here's how I think about this stuff. And I like to tell you that what I'm about to say has a little bit of a religious connotation associated with it. I recognize we're in financial services. We are not running an after school daycare program here. So we need to think about being stewards of other people's capital, opportunities to transact on, et cetera. But there are some other elements here that people need to be aware of as a starting point. So in their religion the quote unquote supreme leader is elevated between their God and the Pope. They're higher level than the Pope. So we just killed their Jesus equivalent, if you will, in some form, right? That has massive spiritual implications to religious zealots, men of God, et cetera. So you have to start with the point that their resilience or their view is a lot stronger than yours or mine's, David. I mean, I could buy a stock, go to the bathroom and come back and change my mind and say, sell it out. Those guys are never changing their mind, right, wrong, or indifferent. Then secondly, once you eliminate that position, it's not as simple as I took the prime minister of Venezuela, Maduro. It's a different level of a person that they just took down. Then you recognize that there are 3 bodies underneath that: an administrative body, a religious body, a military body, that then go and elect the next guy. Okay? Fine. The next guy got elected on Sunday, apparently. Israel assassinated that guy 10 minutes later. So the second Ayatollah was removed. It's difficult to make an argument that there's a third, fourth, or fifth spiritual leader in that stature right under their God that commands the respect and authority of their population, religious or not. It diminishes as you go. So the first step is, in my theory, is that they need to rip apart that chain of command from the spiritual leader down. And once that's done, then you can have a different conversation about regime change, right? And one way to think about that would be, again, this is divide what I'm going to say in half, but if I saw no missiles fired from Iran for a 12-hour window, I would think one of two things. Either they ran out and their predefined game plan where they have no communication but had marching orders prior to the conflict says, fire until you die or you run out of bullets. They've either run out of bullets or the U.S. has degraded all of those positions all over the map that we're not privy to, and the game is over, right? They can't be a mosquito any longer with whatever they're doing with these mobile units. Once we see, my point is a 12-hour window of no military or no missiles being launched, and they've broken the chain of command due to 2 or 3 of these Ayatollahs being elected and then assassinated. Okay, then we should have a cessation of conflict for a minute for all sides to regroup and decide what's next, right? When that happens, and if you can smell that when that happens, you can short oil with impunity and buy risk assets with 2 fists, right? Because that release valve that you just described a moment is not the same thing as Venezuela getting, torched or North Korea being dealt with. This is something that has been the primary source of geopolitical risk for 40 years, deeply embedded in the risk premia of every structure, including the speed governor of the world, energy, right? That release valve is very meaningful. And the reason it's not just about removing that risk. It's about, just to get more wonky about this, the second that opens up, resending Jared Kushner in to meet bin Salman in the Kingdom of Saudi Arabia, putting a deal together between Saudi Arabia and Israel, right? Now we're talking about X hundreds of millions of people coming out of the Stone Ages are going to buy an iPhone or Starlink, right? And by the way, I'd like to remind people, in Iran, many of these people are educated. They're smart. They want a better life. They want to be economic. This isn't, these are not all the same over there, right? That some people think they are. These are good people. They have a history of that. They want to move forward. That's an economic momentum train that would be coming afterwards that has been pent up for decades. And so somebody's going in there and saying, how do I make money out of that? Or lots of people are going to. And that's what would be coming if they're able to break that chain of command. There's some more wood to chop certainly underneath that, but that's what that would imply to me. That would be my coastal clear.
It's great to think about. I have no concept of, when something like that could take place. It's probably later than sooner. But I do believe in a brighter future.
I'll leave you with this. It's great. I've always said, people ask me, they hold the Federal Reserve up on a pedestal most of the time. If you're a macro person, you're like, you can't make fun of the Fed. You have to be professional. The truth of the matter is they do 2 things. One, they're in last place, and one, they're in first place. In terms of their economic forecasting, if you took them versus 25 banks, they're ranked number 26. They're the ultimate worst forecaster. So listening to their summary of economic projections or their dot plot, I find that to be detrimental to actually investing. On the flip side, where they are number one is when there's a crisis and they come in and ring fence that market. Make a simple example or lateral discussion. When they came in during the pandemic and said, I'm ring fencing the muni market with $10 trillion, that's your signal that you can wave those in on the weakness until you're blue in the face, because their baseball bat and balance sheet will be bigger than yours ever will be. That's what I think about here is that when you get a signal that says the Fed is coming in to ring fence Iran, like Trump said today, I just ring fenced the Strait of Hormuz. You can say you don't like the guy, but there's no evidence to disagree with him when we just sunk their entire Navy in 2 days and ours is still standing untouched because we're the best and strongest and most advanced armada in the world. That's a signal to say, okay, do I have a green light to put, I've got 5 bets to make or 5 units of risk. Maybe I put one to work today on that weakness because he just told me to do that. These are trial balloons. They're visible. You want to embrace them because it doesn't matter whether you like him or not. I think this guy just demonstrated between Venezuela and this largest buildup in the history of military confrontation that guy comes back disproportionately with the largest military in the world. Probably not best to fade that.
Neil, we only have a couple of minutes left, and I don't want to leave the podcast without talking about what could happen next, and maybe how we position ourselves. There's this knee-jerk reaction that you have as an investor to, chase what is seemingly like an urgent trade, like right now, like, oh, I got to buy energy, to protect my portfolio, or I need to get out of the emerging markets. I need to get out of all bonds. And we do these knee-jerk reactions, and they're almost always wrong. And if you don't have any exposure to some of these areas that are getting hard hit right now, and longer term, this is what you're supposed to be doing, what's the next thing that you do in the days and weeks ahead?
Yeah, that's appreciate that mindset and you asking it that way. So basic framework, and this is time tested. I'm not making this up, but we're able to write it down. You can read about it. But in general, this is your framework, right? Everybody knows that nothing lasts when it comes to military conflict for more than 10 days. And it's always been some buying opportunity in risky assets. Okay, fine. So you ask 3 basic questions first to get your head in the right place. Number 1, is a superpower involved? Number 2, can it impact the global economy? And number 3, is crude oil or a choke point of crude oil involved? And then you ask a secondary set of questions is this happening on U.S. soil or foreign soil? There's a big difference between 9/11 or the USS Cole being bombed in the Persian Gulf, right? And so once you get your head around that and you said, okay, the U.S. is involved, but it's not like we're against China or Russia, right? So no big deal. We're going to, military, nobody can stand against us. Box checked. Number 2, is this going to impact the global economy? Yes and no. Yes, negatively at first, but we may have an entire new region of commerce that's coming up so that the impact may be positive, not negative, once we get through the crude oil short-term shock. And number 3, is crude oil involved? Yes, except for the fact that the United States is now a net exporter of crude, and they're likely going to have, I would argue, if we succeed in what we're doing, now we have Venezuela and we have Iran. We control 70% of China's oil. They're going to play a lot quicker ball with help me get Russia and Ukraine solved and stop bothering me about your rare earth metals because I got 70% of your oil. The playing field just got leveled. That's Trump's 3D or 4D chess argument, right? It's all playing out as we speak. So you'll say to yourself, this is a buying opportunity ultimately. And then finally, the secondary set of questions. None of this is happening on U.S. soil. Don't get me wrong. I don't want to discount or disparage life. If there's a terrorist cell or element that leads to a mass shooting somewhere and a dozen people are hurt or die, that's important, but that's not going to disrupt the economy. We deal with that on a regular basis, right? And so we check that box too. So the answer to your question is, David, once you go through that basic 3-step process, you say to yourself, this is a buying opportunity and something that I missed early on. The first part comes in and says, and I'll just give you an anecdote. We're a fund manager. We have 7 funds. We have hundreds of phone calls with our sales team to start the year to sell our products like anybody else. And AI, being as brilliant as it is, takes our transcripts, drops them in a file, and I say, give me the 3 biggest talking points of the year so far between hundreds of phone calls with financial advisors. And the number 1 is the number 2 is such a distant second from the first one, which is, how much international exposure do I need, right? And the simplest answer is, well, how much do you have versus what you need? And you say, okay, what's the benchmark for global equities like the S&P 500 equivalent is the All Country World Index. That says you should have 35 to 37% international stocks, so you're diversified. Okay, how much do you have? The average answer is probably 10%. And so this game is in like the second or third inning after 15 years of being dormant. The sleeping dragon woke up. So you missed everything, fine. You know you need to go at least slice the risk in half and go from 8 or 10% to 17, so at least you're in the game. If I just told you there's a 10% correction and you were, lined up to get some, I'm not really quite sure what you're waiting for. You should be over the next week.
What kind of pace do you do this at? Do you if let's say you're going from 10 to 20, all right, and you don't know what the future is, how much do you do tomorrow?
For me, David, I'm a simple guy. I buy the close every day for 30 days straight and close my eyes, and I don't care because I have an 18-month plus view on that. If I'm day trading, sure, you got to be more selective with that. Here's what I would do. I'm placing an order for the next 30 days in increments every day. I'm doing a transaction to buy that. However, if I wake up tomorrow or Thursday and you see 12 hours of cessation of Iran being able to fire anything, and there's no new Ayatollah, and we broke the back of the mullahs on the IRGC, you put that all to work right now in what you were waiting for, and you don't hesitate. That's the game plan. That's our predefined game plan.
How about fixed income? Same thing if you have no duration right now?
Nah, fixed income. I think that's a different animal, at least in the United States. Here's how the United States is just a muddle along. We may cut the interest rate 0.5% this year. Big deal. There's no pricing of a full-blown easing cycle. There's no sign, certainly, of raising an interest rate. So this is a coupon clipping environment, a medium opportunity. You're getting a reasonable yield. It's just business as usual. Don't make more of it than it really is. The real trade, very similar to certain equity markets that you're waiting for, is in emerging markets, which are certainly crowded. And they've had the last 2 days some serious drawdowns in those currency adjusted markets. And so if you find something that's down 4 to 7% in the bond world over there, especially in Latin America, that I would be increasing our allocation at a much swifter rate, because that's a material pullback. I mean, that's like the equivalent of the S&P falling 20 already, right? So we like buying weakness in international equities and emerging market debt in this profile. I leave the crude oil conversation to those with, who've got
I don't want anybody watching this show running out buying crude oil futures.
That's not in our jurisdiction.
Not my thing either. Neil, great stuff. I know a lot of people. I'm going to get a lot of emails on this, and they're going to ask me one thing. How do I get in touch with Neil? How do I get in touch with Rareview? So if somebody wants to reach out to you directly or to the firm, learn more about Rareview, where do they go?
Always on our social media presence, www.rareviewcapital.com or at Rareview Capital on X, those kinds of things. Your contact information is there. We also have something you can fill out on our website, either on the contact form or on any page. You can subscribe to our commentary. And if you're an institutional client or shareholder of our products, we make our research available called Sight Beyond Sight, which is much more institutional in nature, if that is of interest to you as well.
By the way, I've seen it. Make sure if you can get a hold of that, get it. Every advisor should be looking at that. Neil, again, thank you so much. We're going to have to do it again. And thanks for the short notice coming in, when it really hit the fan. We really needed it.
I hope, David, thanks for having me here. I wish we were here under better circumstances. I'm increasingly confident that in the coming days and weeks that we're going to have a breathing room here where a lot of risks in the world have been removed, and hopefully we have a lengthier period of peace. And so it'll be good to have.
Yeah, from your mouth to God's ears. Again, Neil, thank you. That's it for this week. If you want to learn more, of course, about yours truly or the Money Runner, don't forget, go to my Substack site, DCNelson123 at substack.com. I'm David Nelson, and this is The Money Runner.